So why is everything rallying but not Bitcoin? Stocks are up with the S&P 500 up almost 20% this year, gold is ripping up more than 70% this year, and silver's ripping even harder, up 140 to 150% this year, all while Bitcoin's been getting sold off. We've had a pullback from the October high until late December, and Bitcoin is currently down 4% on the year. So the question is real: how can the tape look bullish basically everywhere else except for Bitcoin? And the first thing we're interested in is selling pressure this year. Some sources show Bitcoin whales sold $15 billion worth of Bitcoin in 2025. As you can see here, this is Bitcoin's net realized profit and loss. Every green bar represents Bitcoin actually being sold at a profit. And throughout 2025, especially after the highs, you've had repeated spikes in realized profit, sometimes billions of dollars every single day. And what matters here is what price did next. Even with that level of distribution, Bitcoin didn't unwind the way it did in previous cycles. Price pulled back, stabilized, and held structure. And if you're just watching price action, there's an important macro piece that you might miss: real yields. This chart is the 10-year TIPS yield. TIPS is an abbreviation for Treasury Inflation Protected Securities. It's basically the real interest rate after inflation, and late December it's been around 1.9%. That number is a big deal because it's the market saying you can earn a real return in safe assets, and when that's true, the hurdle rate for everything with pure optionality goes up. Bitcoin doesn't have cash flows, it's a monetary premium and an optionality asset, so it trades like your long duration. The payoff is in the future, which means the discount rate matters. So even if liquidity might be coming later, in the present you can still get Bitcoin lagging because the opportunity cost is still high. At Summit, one of the ways we like to see if the system is actually risk-off or not is credit spreads. This is the US High Yield OAS. What this is basically a measure of how much extra interest or yield investors demand for holding risky corporate bonds compared to holding safe US government bonds, treasuries. You can basically think of this as a high yield spreads chart. In late December, it's been around 2.8 to 2.9%. And if the world was truly breaking, spreads would be blowing out, and they're not. Credit looks calm. This is important because it tells you that Bitcoin's drawdown isn't necessarily the economy is collapsing. It's more like Bitcoin is working through its own supply or positioning reset, while broader credit conditions are still relatively stable. Now let's get into the part that everyone actually cares about: liquidity. And this isn't the version you've seen if you're on X. This isn't the M2 money supply. This is the Fed's balance sheet. Late December, it's roughly 6.58 trillion. And the big point here is markets don't trade the label QT versus QE. They trade the direction of drain versus stabilization, or as some would call it, the slope of liquidity. And as we can see here, for the past 4 years or this cycle, it's been sloping down. And if we're trying to figure out why an asset's lagging, especially one that needs liquidity, we want to see this slope up. And here's some evidence of this. In December, the Fed very explicitly moved into stabilized reserves mode. Starting December, the New York Fed announced reserve management purchases starting with about $40 billion worth of Treasury bill purchases every single month. This is literally the system saying we need to keep reserves ample so money markets don't get stressed. And that matters because if your bear case for Bitcoin is tight stays tight all through 2026, you can see why people doubt that. And that's what we mentioned last video. The moment plumbing gets stressed, policy doesn't announce a bailout, it quietly shifts towards keeping liquidity stable. Here's what we like to call the plumbing dashboard, and it's basically these three things: bank reserves, which are the raw fuel in the system; reserves repo, which is excess cash parked at the Fed; and the Treasury general account, which is when Treasury builds cash, it can drain liquidity, and when it spends, it injects it. These are important, and you don't argue with them, you just watch the direction. And right now, reserves are stabilizing, excess cash is leaving the Fed, and the Treasury flows aren't draining liquidity. That's a very different setup than liquidity being a headwind. And it's important to notice when stocks are up, commodities are up, and Bitcoin is down, what you're really seeing is three different markets with three different demand engines. Liquidity right now isn't expanding, it's stabilizing, and that difference matters. When the system shifts from tightening to don't let the plumbing break, the first assets to respond are the ones with structural demand and low convexity. Stocks have buybacks and systematic flows. Commodities respond to stable funding, inventory cycles, and hedging demand, but Bitcoin doesn't. Bitcoin needs incremental risk-taking and balance sheet expansion. So if you want the simple answer when Bitcoin catches up, it's when liquidity stops being a drain and becomes stable and the market finishes absorbing old supply. Because what we're looking for here isn't the 4-year cycle to continue, it's for Bitcoin to reset, stabilize, and then enter a new macro environment. And when you zoom out at everything we've talked about today, like liquidity, and in previous videos we've talked about gold and silver, the US debt situation, Japan, it all starts to look like the macro is going to outweigh the 4-year cycle completely. Going into next year, you could even go as far as saying the cycle becomes irrelevant, not because Bitcoin changes, but because the environment does. These are some of the most important times to be part of a community. Whether you want to be involved in the daily conversations we're having about macro environments and different types of markets, see what everyone else is trading, or you just don't have time to do all the research yourself and you want access to our macro analysts, technical analysts, and trading view indicators, it's all inside the Discord. You can join the free Discord, follow us on X, and of course if you liked the video, please like and subscribe.